Hello, everyone. Thank you for joining us for the CCIM Institute webinar, Capitalizing on Opportunity Zones in Section 199A. I am Liz Vincent, CCIM's Government Affairs Liaison, and I want to thank Evan Liddiard, Director of Federal Tax Policy, and Erin Stackley, Senior Policy Representative, Commercial Legislative Policy of the National Association of REALTORS, for providing this impactful member benefit. Evan joined the National Association of REALTORS in January 2013 after serving for more than 20 years as a Senior Tax Policy Advisor to Orrin Hatch, current Chairman of the Senate Finance Committee. He received his undergraduate degree in accounting from the University of Utah and also completed a master's degree in legislative affairs from the George Washington University and then a master's degree in taxation from American University. Erin has been with NAR for over 6 years. Prior to that, she worked on Capitol Hill and for the National Federation of Independent Business. She received her BA in Political Science from James Madison University and her Juris Doctorate from George Mason University School of Law. We are looking forward to learning more about how these two new developments will affect the commercial real estate industry and how investors can best capitalize on these new tax developments. Before we begin the webinar, a few housekeeping issues. Please mute your lines to ensure there is no disruptive background noise. To submit questions, please use the chat feature in the bottom left corner of your screen. Evan and Erin will take questions after each section of their presentation and respond to any additional questions at the end. We are recording this presentation and will email a copy of it by week's end. Thank you, Evan and Erin. The floor is yours.
Hi, everyone.
Hi, Erin.
Just making sure that our audio is working. So thank you so much for having us. We're really excited to be giving this presentation on these two new, very interesting and very exciting aspects of tax law that may be impactful to commercial real estate professionals. This is Erin Stackley. I'm going to be kicking off first discussing the Opportunity Zones program. And I'm going to go through some slides, at the end of which we'll have time for some Q&A. Then Evan's going to discuss the 199A aspect, and there will be another opportunity for Q&A at the end of that. So let's get started. Opportunity Zones, a new tax incentive. So what is this program? Opportunity Zones are a new federal program created by the Tax Cuts and Jobs Act of 2017. The program's point is to promote investment in distressed communities, labeled Opportunity Zones, through tax incentives for investors. It provides two types of capital gains relief, which I'll go into in more detail momentarily. First, a benefit for gains reinvested into the program, and second, a benefit for gains accrued while invested in the program. The zones themselves were nominated by the governors of each state or territory and the mayor of DC, and they were finalized by the IRS and Treasury in mid-2018. These zones are final. The agencies are currently working through the notice and comment rulemaking process for the program. The first round of proposed rules were released in October of 2018, and the second round of proposed rules we've just learned are expected in January 2019. That would mean that there's a possibility for final rules by mid-2019, but until then, the rules that have been proposed are effective to allow people to participate in the program immediately. So what you see on your screen now is a map of the opportunity zones. And I know it's not very detailed, but this gives you some idea of where they're located. They are in every state. You may notice down on the right-hand bottom that all of Puerto Rico has been designated as a zone. In total, there are more than 8,700 census tracts that are in the opportunity zone, and you can find a more detailed map and listing of the individual zones on the IRS website. There's a link to that at the end. So, what are the Opportunity Zone program's requirements? Investments in Opportunity Zones must be made through an Opportunity Fund, or O Fund. These may be a partnership or corporation organized for the purpose of investing in Opportunity Zone property. The O Funds must hold at least 90% of their assets in Opportunity Zone property within a zone. And the IRS wants this program to be easily administered and available. So opportunity funds are self-certifying through IRS Form 8996, which is a form that can be filed with federal income filings. The 90% asset requirement will be assessed based on asset values reported on financial statements for the year. And actually, before I go on to the next slide, I just want to announce this is being recorded, so it will be made available afterwards. And if you have any questions as we go through this program, please type them into the chat box, and we'll answer all of those at the end of each section. So, moving on, what are the Opportunity Zone requirements for qualified Opportunity Zone property? Qualified Opportunity Zone property includes stock, partnership interests, or other tangible property, such as real estate, and equipment used by a business, so long as it is substantially all in an Opportunity Zone. The substantially all requirement is met if at least 70% of the tangible property is owned or leased in an Opportunity Zone. It must have been purchased after 2017, and either its original use begins with the Opportunity Fund or the Opportunity Fund substantially improves it. For purposes of this program, the substantial improvement requirement is met if at least as much is invested in the improvement as was paid for the used asset. Under the proposed rules, this does not include the basis of the land a business sits on, which significantly reduces the investment amount required. The IRS rules have not yet covered how to define original use for this property or program, and that is really a question that's impacting properties that are vacant or abandoned. So that's something we'll be looking out for in the next round of proposed rules. So once you have an opportunity fund and you're ready to invest in an opportunity zone, what are the tax benefits? Why would you bother doing this? Well, as I mentioned, there's two kinds of capital gains tax incentives. First, for capital gains that are reinvested within 180 days of the sale to a non-related party into an opportunity fund, the tax paid on those gains is deferred until the earlier of either selling that interest in the opportunity fund or December 31st, 2026. Additionally, reinvested gains that are kept in an O fund for 5 years are eligible for a 10% reduction in tax. And if held for 7 years, that goes up to a 15% tax reduction through an adjustment in basis. So yes, eventually you do have to pay the tax on those capital gains that you've reinvested into an opportunity fund, but you can defer it through at least the end of, through the end of 2026 or whenever you sell your interest, whichever comes earlier. And then you can also potentially see it reduced by reinvesting it into that O fund. So that's the tax benefit on the front end. On the back end, there is an additional separate benefit. Gains that are accrued on investments while held in an opportunity fund are tax-free if that investment is held in the O fund for at least 10 years. This has the potential to be a huge benefit for investors, especially if these investments end up being quite profitable. So what are some questions that we have about opportunity zones? What are some things that the rules answered, and what are some things that the proposed rules haven't answered yet? First, can you invest non-gain funds into an O fund? So can you just take regular money that you've got lying around and invest it through an opportunity fund into an opportunity zone. Yes, but those funds are not eligible for the tax benefits that we just went over. If you make an investment that is comprised of both capital gains and non-gains funds, they are treated as separate investments by the IRS for tax purposes. And only those reinvested capital gains are eligible for, first, the deferral of tax and the reduction of tax, and then the forgiveness of any taxes on accruals that occur while they're held in the fund. Second, is this program permanent? No, unfortunately. The Opportunity Zones designations will expire at the end of 2028. Those are the designations for the physical places that the Opportunity Zones are. But investments made in 2019 and beyond are still eligible for the step-up in basis election through the end of 2047. In addition, as pointed out earlier, with the 2026 deadline of having the initial capital gains invested tax deferred, in order to get the full 15% reduction in taxes paid on that, you would need to invest in an opportunity zone by the end of 2019. So if you invest by the end of 2021, you can still get that 10% reduction for having it held for 5 years, but for that full 15%, it does require 7 years, which would mean investing by the end of 2019. That's part of why they're working so hard to get these rules out quickly, and also why the proposed rules have been made effective. And next up, how does the program treat working capital? There is a working capital safe harbor for opportunity fund investments in opportunity zone businesses that acquire, construct, or rehabilitate tangible business property, which includes real property. I'm getting a little bit of feedback on the mic, so if you can repeat yourself, that would be great. Cash and cash equivalents qualify as business property for up to 31 months. So what's next for this program? Well, as I mentioned, the IRS and Treasury are working through the notice and comment rulemaking process. This is a priority of the administration to get this done quickly, so there is potentially final rules expected by spring 2019. We just had the first set of proposed rules released in mid-October. The second round, it was just announced, we can expect in January 2019. And the IRS is holding a public hearing on the issue on January 10th, 2019. The released proposed rules may be treated as effective for purposes of creating opportunity funds and beginning to invest in the opportunity zones, so you can start today. And in addition, just last week, the White House issued an executive order naming Ben Carson, the Secretary of Housing and Urban Development, to head up the newly created White House Opportunity and Revitalization Council, which will improve revitalization efforts by streamlining and coordinating work on existing federal programs targeting economically distressed areas, which includes the Opportunity Zone program. So this is definitely a priority for the administration. So I'm going to go through an example right now of how this program works, and our example is Irene Investor. Irene owns land that she bought for $10,000, which in 2018 she sells for $60,000, a $50,000 gain. Within 180 days, she reinvests those proceeds into an opportunity fund. So what happens immediately? Well, she can defer paying capital gains tax on that $50K while it's in the opportunity fund through 2026 or until she sells it, whichever is earlier. If she holds it in the fund for 5 years, she'll get a 10% reduction in taxes paid through the adjustment in basis. So $5,000 of that gain will escape tax. If she holds it for 7 years, that increases to 15%. So $7,500 of that gain will escape tax. So, oops. let's talk about the second half of the tax benefit. No tax on appreciation in an opportunity fund if it's held for at least 10 years. So let's say she invested in 2019, and in 2029, her interest in the opportunity fund is now worth $70,000, a $20,000 gain. Normally, if she sold then, she would pay capital gains tax on that $20,000. But since the appreciation was on reinvested capital gains held in an opportunity fund at least 10 years, the entire appreciation is tax-free. So as you can see, this program holds a lot of potential. On this page, we have several links to Opportunity Zone resources, and these will be available when you all get the slides later. However, I just want to go over really quickly. You can see that NAR has a page on our website devoted to this issue, which we keep updated with all of our news and resources on it. The IRS also has a very helpful frequently asked questions page, which has links to other government resources on the program. In addition, the Economic Innovation Group, which is a think tank created by Sean Parker, who is an entrepreneur who worked with Congress to create this program, has some excellent information and resources on its site. That's where I pulled the map from that you saw earlier in the slide. And finally, the CDFI Fund has a page where you can access a detailed map of all the opportunity zones. Just be warned, you'll have to be very patient as it does take quite some time to load, but you can zoom in down to the census tract level on that. So, with that, anybody have any questions? I think there were a few, so I'm just going to scroll up through the chat box here. Let's see. Okay. All right, so it looks like we had a couple questions. Let's see, the first is, what happens if Irene sells at a loss? I think it's just normal treatment then.
This is Evan. I don't think that the taxpayer selling at a loss is going to get the tax benefit for that. I don't know if they're positive, sure, but I can't imagine that this program is set up in a way that will be heads I win, tails you lose for the government. So I would guess that if there's a loss, it would not get tax benefits. You could not take a deduction for it.
To my awareness, they have not said anything about that in the first round of proposed rules. That may be something that they comment on in the second round, or that it's a good question for the public hearing in January. And then there was an earlier question about, can 1031 exchanges include opportunity zone property? Regular tax, I mean, yes, but I don't believe there's any additional benefit to doing a 1031 in an opportunity zone.
They might be thinking in terms of, at the end of the period of 2026, you have to pay your capital gains tax if you still have the property then. Can it be exchanged on a tax-free basis with something else? It's a very good question. Not quite sure if that's actually the context that is being thought of here, or how that might work, but it's a possibility. I'm just not positive.
So let's see if we've had any more questions. Is it possible that different zones will be added? That's a question that's been asked. So at this point, no. The zones that were designated are final for, we'll say, this first opportunity zone program. However, this program has already garnered a lot of interest, and we actually had a bill introduced about a month ago that would reauthorize opportunity zones in 10 years, so after the initial designations had expired. And if that bill were to pass, then we would see perhaps zones that were already designated redesignated if they had not achieved their full potential, or new zones designated. However, the program is so new, that bill probably won't go anywhere in this Congress, but it is likely going to be a discussion that happens as we come to the close of those designated zones, which is 2028. Let's see. Question about if only realized gains can be invested. So no, you can invest non-gain funds, but non-gain funds are not eligible for any special tax benefits. Only reinvested capital gains have the interest that accrues on them, or excuse me, the increased value that accrues while they're in the opportunity fund forgiven if it's held for 10 years. So you can take non-gain funds and invest them just because you think it's a good investment, but they are not eligible to have the capital gains tax forgiven on them after 10 years.
So in the case of Irene that we had before, we had her with a $60,000 value of the property that she paid $10,000, so the gain was $50,000. If she invested that $50,000 gain, that would get the tax benefit. But if she decided to put the whole $60,000 in selling that land into the zone, then she would have to treat that $10,000 differently. It would not get the tax benefits because that's not gain, that's a return of her original investment.
Yes. And let's see. There's a question if $500,000 is subject to capital gains from a sale of stocks. I'm not exactly sure what the questioner was asking there, so we do invite you to reach out to us after the webinar or retype your question with maybe a little bit more context. What happens if Irene dies? Does she get a stepped-up basis?
I don't see why not. I believe so.
Yeah. There's nothing to indicate not. Let's see. Are these qualified opportunity zones set up for JVs?
To the extent that the joint venture is considered a partnership for tax purposes, and I would say probably yes.
Okay. And someone buying, let's see, we have a question. If someone buying in 2019 will not be able to take the full 10-year advantage. I think what this question is asking is if someone invests in 2019, will they be able to take the full advantage of having gains that accrue while invested in the fund forgiven? And they absolutely will. You can actually make that election as late as 2047 under the proposed rules. 2019 is the deadline for investing and getting that full 15% reduction in capital gains on the reinvested gains tax that you would get on the front end. But you can invest as late as 2028 and still get the capital gains that accrue while they're invested in the fund forgiven if you hold it for at least 10 years.
So in other words, even though the enterprise zone itself would end at the end of the period, the investments that you have invested in will continue up until many, many years later.
Another question of whether or not you can do a 1031 out of an opportunity zone fund. I think we kind of already addressed this, but basically we need more clarity from the IRS, I believe, on specifically how they would treat those transactions. But that is the question, again, for the public hearing and the second round of proposed rulemaking. See. We have a question. If Irene invests her gains in an opportunity fund on the 179th day, does the opportunity fund have to purchase real property by the 180th day? I do not believe so. The opportunity fund being set up and certified should satisfy that 180-day requirement.
And the working capital rules give you some time to do the investment.
Yes, up to 31 months, and it's 30 months or 31 months if you have a written plan for how you will be using that working capital. Another question about whether the money invested into an opportunity fund and then into an opportunity zone has to come from capital gains, or if it can be any funds. Again, it can be gains funds and non-gains funds. The only gains funds are eligible for those tax benefits. Do I need to, oh, we have a question here. Do I need to create an opportunity fund when purchasing in an opportunity zone, or can you just purchase as a regular LLC? You will have to do it through an opportunity fund, but the IRS has made it very easy to be an opportunity fund. It is self-certifying through a form with your IRS filings, and an LLC that is a partnership or a corporation can be an opportunity fund.
However, the statute itself does not mention limited liability companies. It specifically mentions corporations and partnerships. I'm not sure if the guidance to date has indicated whether an LLC that's taxed as a partnership will qualify. My guess is yes, but I just don't know for sure.
I believe on the IRS FAQ page they have a question regarding that, and it does say that if they're organized as a partnership, then they're eligible.
Well, an LLC that's taxed as a partnership may not be the same as one that's organized as a partnership, so it may be splitting hairs a little bit, but I'm just not positive about that yet.
Let's see, and then we have another question. Using your Irene example, if Irene held it for 10 years, would she pay any tax on the $70K, or is it just the $20K that is excluded? Yes. So at the end, if she invested in 2019 and she held it for 10 years, so through 2029, on December 31st, 2026, that is when she would owe the capital gains tax on the initial $50K invested into the opportunity fund. However, that would be reduced again by 15%, so $7,500 of that initial investment would not be taxed for capital gains. The $20K that is accrued while in the fund will be tax-free as long as she does hold it for that total 10 years. So 7 years after her initial investment, she would pay capital gains on 85% of what she initially invested, and then she would not owe any tax on that $20K that she accrued if she holds it for a total of 10 years.
Let me mention something about that, though, that may help to clarify. It's possible that owners of opportunity zones could have ordinary income spun off to them as partial owners of the business. We're talking here about capital gains, the increases in the value of the asset that will not be taxed. So if Irene were to own that property for more than 10 years, she would never have to pay capital gains tax on the increase in value of the investment. But it's possible that ordinary income through the partnership or the corporation would have to be taxed as it's earned. For example, rental income that exceeds the operating expenses and so forth. So the tax benefits here are all in the capital gains arena, not in the ordinary income arena. That doesn't diminish the significance, however.
And it is almost 1:30, so I'm going to put a pin in these questions and turn it over to Evan to talk about 199A. And just before I do that, I pulled up the IRS FAQ page, and this sort of somewhat answers the question about LLCs. They had a question, can a limited liability company be an opportunity fund? And the IRS response is yes. A LLC that chooses to be treated either as a partnership or corporation for federal tax purposes can organize as a qualified opportunity fund. So we may need more specific details on that, but it looks like it should be a go. And with that, Evan, take it away.
Thank you, Erin. And thanks to everybody for joining us today. I know there's a lot of other things you might be doing a week before Christmas, but today's seminar is not entirely unrelated to the holidays. In some ways, I feel that Erin and I are bringing Santa's cheer to a lot of people who may not be fully aware of the tax goodies that may be awaiting them. not under the tree, but when you file your tax returns. Erin has just talked about the unexpectedly generous tax benefits from investing in opportunity zones. I say unexpected because many people, when they first saw the bill come out a year ago now, did not realize just how big and bold these incentives were. But I'm now going to follow up with another tax benefit from the 2017 Tax Cuts and Jobs Act that turned out to be much more robust than we first expected. And that's the 20% deduction for qualified business income. Some call this the Section 199 Cap A deduction. As background, the 199A deduction was one of the most significant provisions included in the tax reform bill that was rushed through Congress just about a year ago now. I think it was signed into law on the 22nd of December. It is also one of the least well understood. This is partly due to the fact that it's pretty darn complicated in parts. The provision is also not yet widely known among those who have benefited from in entirety. As I've spoken to realtor groups throughout the year, I've found that typically only about 25% in the audience is more than vaguely aware of the provision. Of course, many real estate professionals are delighted to learn that they'll likely be getting a significant tax cut from this change. I expect that the awareness of this provision is much higher among commercial real estate practitioners, simply because most of you have likely been in touch with your accountants about it. Still, I'm guessing that there are some questions in your minds about how it works, so hopefully this will be very, very helpful. This segment of the webinar is designed to cover a bit about the why, the what, and the how of this new deduction. This overview will be general in nature, and as I mentioned, this topic can be a complex one, especially for those who have higher incomes and sophisticated and multiple business arrangements. Thus, you are well advised to continue talking with your CPA or tax attorney to fully explore how the deduction affects your own situations. First, let's talk a little bit about why this provision was included in the law. As the tax reform bill was being developed last year, there were many ideas that were discussed as being key components of it. But probably the most fundamental one was a huge reduction in the corporate tax rate. This was actually a provision that had some support from both sides of the aisle, and its biggest champion was the president himself. And he made it very clear that there was not a lot of negotiating room over this, as far as he was concerned. He did budge on it a little bit by going from his original 20% to 21%. That was as far as he was willing to go. And so that's what we have, a 21% corporate tax rate, way down from 35% in the prior law. But making such a big change has a lot of implications, both in and out of the corporate world. As you well know, not all business activity in this country takes place within regular C corporations. Indeed, roughly half of all business volume and more than 90% of all America's business entities are not regular corporations. Instead, they're S corporations, limited liability companies, partnerships, or just plain old sole proprietorships. These businesses have one thing in common, and that is they report their business income on their own individual tax returns. The businesses themselves do not directly pay taxes. Instead, the liability is passed through to the owners. That's why they're called pass-through entities. The concerns about drastically cutting the tax rate only for regular corporations were twofold. The first was a political problem for those members of Congress who support the tax reform plan. This was the signal that this bill would be sending to the tens of millions of these smaller businesses who are their constituents that they are not worthy of a tax cut, only the big boys are. This is not a good way to win friends and influence people if you are interested in re-election. The second problem was a more practical one. What was to stop all these millions of small businesses that were organized as pass-throughs from changing their status by incorporating to take advantage of these low rates? Thus, the architects of the tax bill knew that they were going to have to include a big tax cut, a big rate cut for corporations. They also had to put in similar tax cuts in the bill for these non-corporate businesses as well. But this is a real problem because unless there were certain guardrails placed on tax cuts for these kind of firms, what is there to stop regular wage and salary earners from simply becoming independent contractors themselves rather than employees and cutting themselves in on the action? So it was complicated and difficult to figure out how to do this without a lot of abuse. Well, these concerns have been around for decades in connection with S corporations in the area of self-employment tax. Some of you may be familiar with that. The game here is to pay oneself as little salary as possible to avoid having to pay very much in self-employment tax. Well, as the tax bills evolved in the House and the Senate late last year, the question of how to deal with this issue also changed. The National Federation of Independent Businesses was a key player on this, withholding its support of the bill until a key time when they became convinced that the smaller businesses in the country were going to be given a substantial tax reduction under the bill. And in the end, the provision that survived in the legislation was almost too good to be believed, at least to me, and many others have been watching this develop over the months and years before. A 20% deduction from net business income. And just as significant, it featured relatively high phase-out ranges for those who earn this income from their personal services. For many of us who have watched this issue develop, the fact that a high percentage of those who earn business income from personal services could get a significant deduction from this provision was a big surprise. So let's get into some details. This can be rather confusing because it's a brand new concept. Past tax cuts were delivered in a much more straightforward manner, just by cutting the rate. But here, the tax cut is being delivered via a deduction, and a new kind of deduction altogether. So, if you do have questions, hopefully some of them will be clarified when we get to the examples at the end. But so just hang on, and then of course we'll try to answer your questions as well at the end. It's important to note that this new deduction is not an itemized deduction, nor is it a typical business deduction that's based on an expenditure. Rather, it's an across-the-board deduction from net income that is computed after all the other expenses have been factored in. The next thing to note is that the general rule of the new provision limits the 20% deduction to non-specified service businesses. Well, what are specified service businesses? This is tax law parlance for businesses in the following fields, and you can see on this slide here that it means any trade or business involving the performance of services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, investing or investment managing, trading, dealing in certain assets, or any other trade or business where the principal asset of such business is the reputation or skill of one or more of its employees. Now you can see that that is kind of encompassing. And when this language first came out, we were wondering, well, who can take this deduction? And you might be thinking, why are we even talking about this then? Because most real estate professionals are going to be classified in the definition of a specified service business. And again, that's what we expected at the beginning. But there's lots of good news here. And it became even better in August when the Treasury and IRS released proposed guidance as to how this deduction was going to be administered. To set the stage, when this deduction was being debated, we thought that all real estate professionals dealing with buying and selling would be excluded from receiving the deduction, except possibly those with very low incomes, maybe $50,000 or $75,000 a year. But the exception, there was a major exception that was added toward the end of the process that allows almost any business owner with less than a certain amount of income to still take the deduction despite their being in one of these specified fields of business. This exception provides that if a business owner has taxable income of less than $157,500 as a single taxpayer, or twice that amount, $315,000, as a married couple filing a joint return, then the specified service business restriction does not apply. In other words, everyone who has qualified business income will be able to take advantage of the deduction so long as their taxable income is below these thresholds. And for those with incomes above these amounts, there's still hope. First, there's a phase-in range of $50,000 for single people and $100,000 for joint returns. Over this range of income, this deduction is ratably phased out. And we'll have some examples for you in a couple of minutes. Again, here's a list, a look at the list of specified service businesses which are prohibited from claiming the 20% deduction if their income is over those thresholds. Now, the second part of this good news is that when the proposed regulations came out in August, they specifically provided that real estate brokerage is not included in the term of brokerage services. Rather, this term is limited to the brokerage of stocks and bonds and other securities. Services provided by real estate agents and brokers were specifically excluded from the prohibited list. Many of you are aware this big win was at least partly due to the result of a huge effort by NAR in urging Treasury and the IRS by letter and in meetings to remove real estate from the list of specified service businesses. The net result is that, therefore, that real estate professionals who have taxable income below the threshold amounts will be eligible for the 20% deduction. And further, because of the clarification in the proposed regulations, even real estate agents and brokers, other real estate professionals with income above the threshold will be eligible for a deduction of up to 20% if they meet another set of exceptions. Well, what are those exceptions? This is where it gets a little more confusing, but it's worth learning this. For those with business income from a proprietorship or pass-through business that is not from the prohibited list of specified service income, and again, it's now clear that income from real estate brokerage activities is not on that list, there is also a phase-out at the same taxable income levels as I mentioned before. But unlike those people, if the taxable income of those with non-specified service business income exceeds the phase-out range, they can still get at least a partial deduction from the other exceptions, even with these higher levels of income. Here are the exceptions. Number one, it provides that the 20% deduction is limited to the greater of 1, 50% of the W-2 wages paid by the business, in other words, salary paid on and reported on Form W-2, or 2, the total of 25% of those W-2 wages paid, plus 2.5% of the original cost basis of tangible depreciable property of the business at the end of the year. Now, I realize that's a mouthful. It's not as clear as mud to begin with. But I hope it's clear that you might see, in order to get a meaningful deduction, if you're over the income limits, your business will need to either pay out wages to employees or own depreciable property, or both. So again, when we get to the examples, this will be a little more clear. Before I get to those examples, though, I need to give a caveat that we still don't have the final rules about how this deduction is going to work, although we do have a much better idea now than we did before August. The final rules are expected to be released either right before January 1st or right after. In other words, just a few days from now. They're being reviewed this week by the Office of Management and Budget, and this process is supposed to take only about 10 business days. And also, before I turn to the examples, I want to mention one other area of great interest to most of you, and that is the question of whether rental income from real estate will qualify for the 20% deduction. When the proposed regulations came out in August, they did not provide much help on this question. This is because the Section 199A statute itself provides that in order to qualify for the deduction, the income has to come from a trade or business, as defined in Section 162 of the tax code. The problem is that Section 162 does not contain a definition of what a trade or business is. Rather, it has been left to the IRS and the courts to decide when a rental activity rises to this level or is just considered to be an investment. And the rulings of the courts and the IRS decisions on this matter have been all over the map on this question, so it can be a very difficult thing to try to determine. As I tell my tax students, it's helpful to think of this issue as a continuum with a single rental house or a condo on one end and, say, a 1,000-unit apartment or a shopping mall on the other end. It's clear that the mall or the huge apartment building owner is operating a business and not just holding an investment. But when you have someone who owns a single rental house or perhaps a duplex, and he or she only spends a few hours a year arranging for somebody to cut the lawn or to fix a clogged drain, it's a lot less clear. Yet we have court cases and IRS positions that support a small property landlord being considered in a business. But we also have other cases and rulings that go the other way. So it's very hard to know the answer to this conundrum. Therefore, when the proposed regulations for this deduction came out in August, we were very disappointed that they did not make it easier for the 10 million owners of rental real estate out there to determine whether they qualify for the 20% deduction for their rental income. Because these regulations did not simplify the matter, we at NAR mounted a major push to try to get this simplification in the final regs. These are the ones we believe will be released just a few days from now. As of today, we're not terribly optimistic that we'll be going to prevail on this request, that all owners of rental real estate should be considered to be in a business for purposes of the deduction. Instead, we fear that small owners of rental property will have to try to justify that they are indeed in a business, which will often require them to hire expensive accountants or lawyers to prove it. Or those accountants might say they're not in a business, and the owners will either have to forego the deduction or find someone else to sign the tax return who's more aggressive and take their chances on being audited. Later this week, we'll be meeting at the White House asking once again for our review to be incorporated into these rules. It's very important to NAR because we estimate about 40% of our 1.3 million members own rental property. And I'm guessing that the percentage is even higher among many of you, the commercial real estate professionals out in the country. Now onto these examples, which are designed to show not only the impact of the 20% deduction, but also the size of the overall tax change from the prior law from other changes in the Tax Cuts and Jobs Act. So let's start. Trying to get the slide to move. Start with Amy Agent, who is a single person. This is a relatively straightforward example. The single real estate agent I call Amy Agent. She's very active in the business and pretty successful, earning real estate commissions of $67,000 for the year 2018, as you can see. And as you can also see, if we were looking at her tax bill for the prior law, she would be able to deduct her personal exemption of $4,150, as well as claim a standard deduction under the old rules of $6,500. Now, under the new law, she's no longer able to claim that personal exemption, but the much larger standard deduction of $12,000 more than makes up for it, so she ends up with less taxable income, and therefore gets a tax cut from that as well as from the lower tax rates. But it's the $11,000 in the new 20% deduction that she can claim under the new law that is the real star of this show. Some of you quicker listeners may have noted that the $11,000 is not quite a full 20% of her net commissions of $67,000. That's because she's limited under the rules to 20% of her taxable income figured before the new deduction. Thus, since 20% of $55,000 or $11,000 is less than 20% of $67,000, she does not get the entire deduction. But please note that if she had other ordinary income, such as interest or dividends, or salary from a second job, say, this income would be added to her taxable income, and this would increase the deduction to as much as $13,400, which is the 20% of the $67,000 in commissions. The bottom line for Amy is she gets a very large tax cut of $4,206 under the new law, and more than half of that is attributable to this new 20% deduction. The rest, again, comes from the higher standard deduction and reduction in the tax rates. Let's move on to another example. Let's look at somebody I'll call Andy Agent. Let's say he's Amy's brother, but he's married and has a couple of elementary school age kids. He doesn't have as quite a good a year for commission income as his sister Amy, earning only $45,000 in commissions. However, Andy's spouse has salary income of $45,000 for a total amount of family income of $90,000. Under the old law, they were able to claim personal exemptions for each of the four members of the family, totaling $16,600. And also, let's say they had itemized deductions totaling $18,000. This gave Andy and his family a taxable income of $55,400 under the old rules, and the tax on this was $7,358 before the tax credits for the kids. Now, any of you who have kids under the age of 17 know that the old rules would give you $1,000 tax credit per child, but you may not know that now you get up to $2,000. Under the old rule, though, they would have gotten $2,000, one for each, $1,000 for each child, lowering that tax to $5,358. But under the new rules, in that second column, you can see there's several things happening, and most are beneficial to Andy's tax position. He can no longer claim the personal exemptions, but the family does get a much larger standard deduction of $24,000. But that's not enough to overcome the loss of the exemptions, however, but the doubling of the child credit comes in and creates a very nice tax cut compared to the prior law. As with Amy, it's the 20% deduction that really delivers a large amount of the tax savings for this family. The overall tax savings under the new law is about $2,900, and most of it comes from the 199A deduction. Now let's consider Barry Broker, who is a single taxpayer and has a significant amount of commissions income, or brokerage income. As with the earlier examples, Barry could claim a personal exemption and a lower standard deduction under the prior law, and this yields him a tax under the old rules of $46,000 on that amount of income. But under the new law, Barry can no longer claim that personal exemption, but he does get the higher standard deduction. And under the new law, because he's self-employed, he can claim a big Section 199A deduction of $22,936. Well, you may wonder why that strange amount. Well, the reason here is that Barry's income is over the threshold of $157,500 as a single person, but it's not over the upper threshold, so he still gets a deduction, but it stays down. It's less than the 20%. And because it's closer to the lower threshold than to the upper threshold, he does get most of it, and it's still a pretty significant deduction. And his overall tax cut is well over $11,000, and most of it is coming from this new deduction, and the rest of it coming from the lower rates that he is subject to under the new law. Next, let's take Barry's sister, Bobby, who's also a broker, but is married and has a spouse that earns a significant amount of salary income, making $270,000 a year. Together, Bobby and her spouse make over the upper limit of $415,000. Therefore, you're not seeing any 199A deduction for this family. Here we're assuming that she pays no salary to her employees in the business and has no depreciable property. If she did either pay salary or have property, she might be able to claim a deduction under those second sets of exceptions, as we'll see in the next example. But even without the example, Bobby and her spouse receive a very nice tax cut from the prior law. This is largely due to the cut in the tax rates. Had their total family income been significantly below the upper income threshold, they would obviously be getting a much bigger tax cut because that new deduction would kick in, and she probably would turn out with a better off here. Finally, let's consider the example of David Developer, who is also part of a high-income family. He pulls down about $450,000 between his salary that he draws from his S corporation and the net income from that entity that is passed through to him. This amount, less his itemized deductions of $35,000, leaves him right at the higher phase-out level for getting the 20% deduction. However, you remember the second set of exceptions that we discussed earlier? Where if you have W-2 payments from your business and depreciable property, these can be the basis of the deduction. Those are both at play here, as we note that David has salary income paid by the S corporation of $80,000. In the case of an S corporation, when you pay yourself, that counts for that W-2 exception. We also assume here that the business owns a building and other depreciable property worth $1.8 million as to its tax basis. 25% of the salary of $80,000 or $20,000 can thus be added to 2.5% of the property basis, which comes to $45,000, to create a maximum amount for the new 20% deduction of $65,000 in this case. Now, David's maximum amount of the 199 deduction is $74,000, which is 20% of the $370,000 that was passed through to him. But since the limiting factors of salary and property basis, he has to claim the lower of $65,000 or $74,000. Therefore, if David wanted to maximize his deduction, he could pay out more in salary, assuming it didn't impede his net income, or he could buy more assets for his business, which would increase that other factor. But again, as with the other examples, David receives a very nice tax deduction compared with the prior law, and most of it comes from this new deduction. Nobody's going to scoff at the idea of a tax cut of $38,000, even though this person's making a pretty good income. And with that, let's see what questions we have to talk about here. So if you have a lot more questions on opportunity zones, let me see if I can find any on the 199A before we go back to those. I'll go all the way to the bottom. Looks like there's plenty of questions that have been asked here. Question, has TurboTax been updated with all these new tax laws, or do I need to consult a tax professional? I'm virtually certain that by the time you file your return, TurboTax and other major tax software packages will have these new laws built into them. If you're a sophisticated business owner and think that you might be eligible for either of these deductions, though, it might be wise for you to consult with a CPA. And I'm not just saying that because I am one. I think it's a good idea and maybe well worth your extra money and time. Question, was the qualified business income reported on Schedule C? That's a very good question. I'm not sure that we know that yet. Many of the new tax forms have been in draft form, but I haven't seen one on this one that indicates whether it's going to be on the front page of the return or on Schedule C. My guess is it would be on Schedule C, but I just don't know yet. Okay, question. Are there situations where both owning property and paying W-2 wages are required to be eligible? The answer is no. It's going to be one or the other, or a combination of the two. If you have just W-2 wages the business is paying, then you can take advantage of that 50% exception. If you have just depreciable property, then you take advantage of just it's going to be a combination of 25% of the W-2 and 2.5% of the business assets. Next question. It looks like we have more opportunity zone questions, so I'm going to turn it back to Erin to try to ask and answer those.
Okay, and we actually just have a couple minutes, so I'm going to try to find one. Here's a good one. What happens to property already owned in an opportunity zone before this program? Can you create an opportunity zone fund and have investors invest and receive capital gains? So this has been a question that's been raised at a couple different forums that I've been to. You happen to already own property in an opportunity zone, shouldn't you have some of these tax benefits available to you? From what I understand, it does have to be original use or new use, or original or new use within an opportunity zone for business property to be eligible for those capital gains being forgiven at the end of the 10-year holding period.
However, it's not totally clear, and a lot of entities, including real estate entities, are writing comments to Treasury and IRS right now, urging that in the case of real estate, that the final regulations allow an owner of a present piece of real estate in an opportunity zone to be able to accept, to include it as opportunity zone property, and to use funds coming in from others and or from themselves to improve the property and turn it into eligible property, because they feel that, and I do too, feel like that's totally in the spirit of what this whole opportunity zone program is about. So we're hoping, we're asking for that to be the case in the final regs, but we just don't know the answer yet.
And it is actually 2 o'clock right now. So I know that there are other questions. We encourage you to reach out to us directly. I believe they'll be sharing our contact information with those. Thank you so much for your time, and we will turn it back over to Liz at this point.
I want to thank Erin and Evan so much for sharing their expertise on opportunity zones and Section 199A, and to thank you all for joining us for the webinar during this busy time of year. We'll include, as Erin pointed out, we'll include Erin and Evan's contact information with the recording link that we'll be sending out by the end of the week if you have any further questions. And I wish everyone a wonderful holiday. Thank you so much for joining us today.